In a previous video, we talked about how to account for debt securities when they're categorized as held to maturity. But we can also categorize debt securities as trading securities if we intend to trade them or sell them in the short term. And so with held to maturity, we had recorded this debt or the bonds that we invested in at amortized cost. But with trading, we're actually going to mark the securities to market. We're going to mark them at fair value, and any gains or losses are going to go to the income statement. So I just want to walk you through our example that we used before and show you how we would make the journal entries. So let's say that this firm, Adventures Unlimited, issues a 3-year bond with a face value of $1 million. And nothing has changed from our example that we had when we looked at held to maturity securities. So I'll just run through this quickly. We have a stated rate of interest that we're going to receive of 9%. So that means, and this is annual interest, so we're going to receive $90,000 a year in interest on these bonds that we're investing in. Now the market rate is 7%, and we're receiving 9%. So we're going to pay a premium to get these bonds. And the premium we're going to pay is $52,486. So the amortized cost of the bonds, the fair value, in the beginning, at the very first day that we buy the bonds, is $1,052,486. That's just the face value of the bonds plus that $52,486 premium. Now, we've got our effective interest rate table here, and we're going to amortize this bond premium, right? And so the difference between the cash that we receive and our interest revenue is going to be the amount of the bond premium that we amortize in each period, right? So this interest revenue that we receive at the end of year 1, that's basically, we're just taking the amortized cost of the bond, and then we're multiplying it by the market rate of interest, that's 7%. Okay, so that gives us our interest revenue is $73,674 in period 1, and then the difference, the $90,000 we receive minus that interest revenue, is going to equal the amount of the bond premium that we amortize. Okay, and we've talked about this before, so I just want to quickly walk you through the journal entries. So we're going to debit trading securities. With the held to maturity, we just debited held to maturity securities, so it's really no different, it's just a different name. We're going to debit trading securities for $1,052,486, right? That's just the amortized cost and the fair value. They happen to be equal in the first period. So, and then we're going to credit cash. We're assuming we're paid cash for these bonds, $1,052,486. And then our first journal entry, we're going to debit cash. We're receiving cash of $90,000, and then our interest revenue is $73,674, and I'm just getting that from our table. And then we're going to reduce the trading securities account by the amount of the bond premium that we've amortized. That's $16,326. That's going to make our debits and credits balance here. If any of this is confusing, just go back and watch the video we did on the held to maturity securities. Now here's where things get different from the held to maturity securities. We need to make an adjustment because at the end of the first year, right, on January 1st, 2020, we've got where our amortized cost and our fair value are now different, right? So the fair value is higher than the amortized cost. So if you think about it, we've had a gain. We've had a gain, and we need to record that, right? So what we're going to do is we're going to debit fair value adjustment to the trading securities, and so that's going to go on the balance sheet, and that's going to increase the trading securities account. So that asset will be increased. We're just marking it to market. And then we're going to have an unrealized holding gain, right? So we're just going to credit this account unrealized holding gain or loss, and it's going to be a gain. Now, how much is it going to be for? Well, we just take the difference of these two amounts here, right? So we take the $1,037,000 fair value minus the amortized cost, $1,036,160. And that's going to give us $840. That's the difference between those two. So this is $840 that we're going to be crediting. So what is the practical effect of this? Well, the fair value, right, if we were to look up the trading securities on their balance sheet, they're going to be $840 higher than the amortized cost, right? So if we were categorizing these as held to maturity, we look up what the value of these bonds are on our balance sheet, it would be $1,036,160. But since we're classifying them as trading securities, when we look it up on the balance sheet, it'll be $1,037,000, right? We've marked it to market. And then we've got this $840 unrealized holding gain that is going to go to the income statement, and it's going to be recognized that it's going to improve or increase our net income.